Hello traders, welcome back to the Forex Gig, where we dive deep into the tool that can help you make smarter trading decisions. And in today's video, we are going to be talking about the automatic non-repaint 95% accurate supply and demand zone indicator. This tool aims to simplify your trading progress by automatically identifying key market levels. You will learn how this indicator works and how to incorporate it in your trading strategy. So stay tuned to discover a potential game-changing approach to your Forex trading. We start by understanding what supply and demand zones are. Supply and demand zones are essential areas on price charts where market tends to reverse or stall. A supply zone is formed when selling pressure outweighs buying interest, causing price to fall. Conversely, a demand zone is an area, this is a supply zone, where causes price to fall. While a demand area is a place in price, is a zone in price where buying pressure exceeds selling interest, driving price to the upside. And as you can see, from this area to this area, price came to retest this zone in this place. It's meant to extend to this area, and price was moving to the upside before it eventually got broken. This is basically zones. These are basically the demand zones in the market. This is how we understand demand and supply zone. Now let's see how we can use this indicator for our trading strategy. The automatic non-repaint 95% accurate supply and demand zone indicator. It simplifies your trading progress. It simplifies your trading progress by identifying key market levels. To effectively use this, you can start by installing this on your platform. You can enable this on any platform you are using, either your MetaTrader 4, your TradingView, or your MetaTrader 5. Once you have automatically installed this indicator, it will plot your supply and demand zones on your charts. It will automatically plot your supply and demand zones on your charts. These zones appear as colored boxes, with the supply zone typically showing red and your demand zone typically showing green or blue. Focus on these verified zones for high accuracy in your trade. So when approaching a trade, you wait for price to near this area for a strong demand zone, for a potential buy opportunity. When price nears this area for a potential buying opportunity. These are the areas of demand. When price nears these areas, we expect price to react from this area. This is a potential demand zone. As you can see, it extended to this area. So this is a potential demand zone. You wait for price to get to that area for a potential buy setup. You look for your confirmation signals such as your bullish engulfing or your pin bar. You can look for your bullish engulfing at that area or your pin bar. That will help you to take your trade near the zone. It can be near the zone, or price will react on the zone and leave. You need to look for your area, your signal, your candlestick signal at that area. And as you can see, a bullish engulfing. This is where we'll be looking to enter our trading position. You set a buy limit or you enter the trade automatically. You set your stop loss just below the demand area. This is where you set your stop loss just below the demand area. Your take profit should be your next key zone. It can be your next resistance area from the indicator, or you can go for a fixed risk to reward of 1:2, 1:3 to capitalize on your trading opportunity. Now let's see how we can enter a selling position from your supply area. To enter a selling position, you need price to get to that your selling region. When price gets to that your area of resistance, as we can see price is reacting from this area, there's even another zone up here. When price gets close to that area, we enter our trade after we see a candlestick pattern. We can see an indecision candle here followed by a bearish engulfing candle at that area. This is where we'll be looking to enter a short position after our candle close. We enter a short position, you put your stop loss just above the resistance. It can be this resistance or this resistance here. But to give your trade more room, you go to an area that will invalidate your setup. You target a risk to reward of 1:2, 1:3, or you target the next demand area. This can be your take profit area. This is basically how to use this strategy to your advantage. Now let's look for another opportunity. We can see another opportunity in the market at this area. When price got to our supply zone, it peaked above, formed a doji indecision candle, then we would enter the trade at this level. If we go to the lower time frame, we would find out that we would have seen a better opportunity to capitalize on this candle, and we will take the trade around where we see an engulfing or whatever candlestick we see at that area. Then we place our stop loss just above the resistance line that has been marked. Your take profit should be at the next support area. This is basically how you take the trade. If you want to take a buy trade, we can see this our zone. This is our demand zone. It's meant to extend to this area. We look for our candlestick pattern at this demand zone area. We can see a bullish engulfing at this area, and we can see a hammer at this area. So I will take this hammer candlestick pattern. Once price closes above the hammer candlestick, I would enter the trade, put my stop loss just below the demand area, and I will take my profit at the next resistance area, or I will take my profit at a risk to reward of 1:2 or 1:3, as the case may be. This is how we capitalize on this trading opportunity. Alright traders, we have come to the end of this video. Engage with us in the comments below. We want to hear about your experiences. If you found this video helpful, do not forget to like, share and subscribe to the channel. Turn on your notification bell so that you wouldn't miss out on more trading tips and strategies. Thank you for watching, and I will see you in the next video.